This is Matthew Kratter from Trader University, and today I want to answer the question, can stocks survive the banana? This video is in response to yesterday's video, which really received a lot of pushback. In fact, a lot of people actually thought that it was a parody. In fact, this was actually a serious video in which I declared that the bear market for stocks and Bitcoin is over, that the Fed has pivoted, that they're reversing their monetary policy, and that we're back to the races for risk assets. To understand this, we have to first understand what the banana is. This is a reference to a guy named Alfred Khan, who was a political advisor to President Carter back in the 1970s. And this was when the U.S. economy was also in a recession, and President Carter did not like hearing people use the R word, the recession word. And so when Alfred Khan talked about the recession publicly, he would substitute the word banana for recession. So he would say things like, between 1973 and 1975, we had the deepest banana that we had in 35 years, and yet inflation dipped only very briefly. This sounds a lot like current times in which we're dealing with a recession that the administration does not want to talk about. We're also dealing with inflation at the same time. We're seeing quite a bit of pushback from the administration and the White House saying that we're not in a recession. We have even Janet Yellen saying the U.S. economy is not in a recession. This is simply not true. Over the past 75 years, and this is from ECRI, over the past 75 years, there's been a U.S. recession every time real GDP has fallen for 2 consecutive quarters. And that's what we just saw. We got the GDP numbers a couple days ago, and we saw that GDP, U.S. real GDP, has fallen 2 quarters in a row. Every single time this has happened in the past 75 years, there has been a U.S. recession, and it's one of the definitions of a U.S. recession, falling GDP, real GDP growth for 2 quarters. Now, as ECRI points out, you can have a recession without back-to-back declines in real GDP. We had 2 recessions. We had the 1960-61 recession and the 2001 recession. Both of those were cases where you just had 1 quarter of falling real GDP. But it's clear we are in a banana now. We are in a recession. You're even seeing papers like Financial Times saying we're entering a technical recession. And the fight is also breaking out over at Wikipedia, where there's been some editing of the entry for recession. We seem to be in times when we are having trouble understanding the meaning of really basic words like man, woman, recession, banana. But these are the times that we live in, and this is not a Democrat versus Republican thing. If Republicans were in the White House, I have no doubt that they would be doing the same thing and denying that we are in a recession. If you're finding this video helpful so far, be sure to hit that subscribe and like button. So I want to go on to talk about some of the comments I got in response to saying, how could stocks be doing well if we're in a recession? And I got comments. There's a comment from Manfred here. Hey, Matt, you know I love your videos and you've taught me so many things. And maybe it's because I live in Europe where things are really starting to unwind. But how can you say that the worst is over when the war is raging, energy and food shortages are only just beginning? The fact that the Fed will start the money printer soon surely does not mean that the world is not in deep trouble. Got a comment here from Stephen. I love you, Matt, but I think you're being optimistic. Inflation is not cured. If they stop here, there's going to be, the Fed is going to be a laughing stock, something similar that Andrew Hutchinson said. Is the USA headed for hyperinflation? Well, after watching this quite concerning video, I think it might just be. The problem is that if the views Matt expounds on here get widespread currency, no pun intended, then this will lead to a significant loosening of the monetary environment. And that is indeed what I think is going to happen. And it's going to probably push inflation higher. Another comment from Andrew Hutchinson here saying, I don't think Matt or the U.S. markets are pricing in the major economic and political crisis that will engulf Western Europe this autumn and winter when Russia turns off gas supplies. Now, I'm quite aware of the problems in the world, and I did not mean my video to suggest that world peace is breaking out and that there's not going to be possible famine, people freezing to death in the winter. So are the good times back? Absolutely not. The economy is in a banana, and inflation is not going away. And there are going to be very hard times in Western Europe because Western Europe has really put itself between a rock and a hard place. All I was saying in that video is that the Fed has now pivoted, and so it's back to the races with risk assets. The Fed has been sucking liquidity out of the system and allowing deflationary pressures to take over. We've seen up until this point in 2022, basically all asset prices have been falling. Bonds, stocks, crypto, Bitcoin, even housing prices in some places. And so having a really tight monetary policy, this is the wrong policy for tough times. If you're expecting a tough winter and problems like this, you actually want a looser monetary policy. The other larger problem is you simply cannot allow asset prices to fall too much whenever debt to GDP is as high as it is now. And it's very high for Europe. It's very high for the US as well. The problem is if you allow asset prices to fall, you end up having lower tax revenues, as we've talked a lot about, because a lot of tax revenues are driven by not just consumer spending, but also by capital gains on higher asset prices. So when people take profits and they pay their taxes, this is a huge source of tax revenues, especially in the US. And so if you allow asset prices to fall too much or for too long, you end up having lower tax revenues. And this means that the US government must issue even more debt because the government's unable to cut its spending significantly because we have Social Security, Medicare, defense, and interest payments on the debt. And none of these things are negotiable. None of them can be cut. There's no political will to cut Social Security and Medicare. Any politician who tries to do that would be immediately thrown out. So U.S. government spending cannot fall below a certain point. And if you don't have tax revenues paying for a percentage of that, you're going to have to issue even more debt. And then the debt levels get even worse. Lower asset prices, as we said, also lead to lower consumer confidence. This leads to falling consumer spending. Then you have GDP falling, and basically the denominator in the debt to GDP ratio falls, and debt to GDP levels go even higher. This is where we are now. As we've talked about many times, debt to GDP in the US is about 124, 125%. It's much higher than it was in the 70s and 80s, especially the early 80s when Paul Volcker did his magic and raised interest rates above the inflation rate. You simply cannot do that now. If inflation is at 6, 7, 8, 9%, the US economy and the US government cannot tolerate rates that are that high. The US government will eventually default on its debt. It won't be able to make its interest payments. And the other problem is if you allow the discount rate, if you allow Fed funds and other interest rates to get that high, what it means is sharply lower asset prices just because of the way that discounting works when you're discounting cash flows to value assets. And as a result, tax revenues will fall because housing prices will be much lower. Stock prices will be much lower. So the Fed says it does not want inflation and keeping inflation under control as part of its mandates. But the only path out of the mess that we're in is an inflationary path. You cannot risk having a deflationary debt spiral. Deflation, austerity, tightening the belt, these things will never be politically tolerated. Unfortunately, inflation definitely hurts the poor more than the rich. Many of you commented on this. The rich are able to hide out in stocks and other hard assets like Bitcoin and houses, and so they're partially shielded from the effects of inflation, and they can sort of hedge the inflation risk away by owning assets that go up in an inflationary environment. The other thing, though, the U.S. government does not really care about the poor. It cares much more about Wall Street and the asset markets. And so this was the argument that I made, that the Fed has now cried uncle. They've tightened as much as they can politically, but it's not going to be possible to maintain this tight monetary policy in a recession going into midterms. We're already seeing this. We saw the talking points at the beginning of this video where the administration was saying that there's not a recession, Yellen saying it, Biden saying it, even Powell saying it at the FOMC meeting on Wednesday. But here we have Elizabeth Warren, who's obviously quite powerful, saying the Fed's aggressive interest rate hikes are pushing the U.S. economy into recession. She should have said banana, I think. They're pushing the U.S. economy into recession, and the evidence is in the data, while failing to address many drivers of inflation. Of course, one of the biggest drivers of inflation is just the central banks themselves and their money printing. The Fed is pumping the brakes on the labor market and slowing the economy Congress needs to step up. This is the kind of political pressure that we're seeing and we're going to continue to see. And this is one of the main reasons, I believe, that the Fed pivoted. Again, Jerome Powell is a Republican nominee. He was nominated by Trump, so I don't want to make this a partisan thing. The U.S. is in a very difficult situation here where if interest rates get too high, the whole economy goes into a recession. If interest rates are low, we end up with lots of inflation, which hurts working and middle class people much more than people who own assets, as we said. So the U.S. is in this tight situation. The problem is if you try austerity, if you try belt tightening, you are going to be voted out. And so the U.S. has only one path out. That's inflating our way out of our debt. And the Fed will pretend that they don't want inflation. But really what the system needs, unfortunately, is inflation. And so I think we've seen the cycle come here in monetary policy, and we're now entering a much more dovish time. And this is going to be very bullish for Bitcoin prices and very bullish for stock prices. It's bullish for risk asset prices. It's bullish for the financial markets, but there still will be a lot of suffering on the ground. I think energy prices stay high. I think as housing prices continue to go up because of dovish Fed policy, this, of course, exerts upward pressure on rents. We have the whole Russia and energy situation in Europe. So I'm not trying to suggest that good times are here, simply that good times are here for asset prices. And as many of you know, if you take a look at stock prices in Venezuela, in Zimbabwe, and some of these failed states, as they inflate their way out, as they choose the hyperinflationary rate, their stock markets skyrocket. And I think we're seeing something similar here in the late debt cycle. So the video saying the bear market for risk assets is over was not parody. I'm quite serious about this. I think we rally essentially for the rest of the year. There may be some choppiness down here, but I don't think we get anywhere close to revisiting the lows in the stock market or the lows in Bitcoin. I've canceled all my lower Bitcoin limit orders. I continue to dollar cost average. And I wouldn't be surprised actually if we see Bitcoin hit new all-time prices sometime by the end of the year, getting back above 69,000. I think this could happen much more quickly than many people believe. Meanwhile, just because the economy is in a banana, this doesn't mean that asset prices cannot continue to do well. And I think one of the great ironies here is if we get a weak non-farm payrolls number over the next 2 months before the next Fed meeting, if the job growth numbers are really bad, I think you'll see the stock market rally, because what the stock market will be interpreting this as, the stock market will be saying this kind of bad news is actually good news because it means the Fed is done hiking. So we live in this very topsy-turvy world. Financial markets are not always intuitive. I called this financial crisis back in March of this year, received a lot of pushback. I talked about much lower Bitcoin prices, that Bitcoin was going to hit 30,000 and 25,000 and 20,000, and we ended up doing all of that. And now I think we're back to the races. And again, it doesn't mean good times are here. It just means good times for risk asset prices. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.